Welcome back to my channel. I have been creating a series of videos to help you understand the infinite banking concept a little bit better. I call it the investment optimizer. Today, we're going to talk about what drawbacks are there to an infinite banking style policy. In my opinion, it is extremely important to understand what the drawbacks could be to using a policy like this. So without further ado, let's jump into it and get enlightened. One of the drawbacks that's easiest to catch are the initial costs of these policies. Whether it's infinite banking style policy, an investment optimizer policy, or any life insurance policy, insurance companies are known for front loading the costs on these policies during the initial year or two. Even a policy that has been structured properly, or in other words, where we're decreasing the death benefit as low as it can go and then overfunding with paid up additions as much as we can up to the IRS guidelines, which is the modified endowment contract or the MEC limit, you will not have your full capital available to utilize during those initial 2 years. What it looks like is when you fund that first year, you're going to see about 70 to 90% of what you put in will become available to use in cash value. The second year, those fees get a little bit smaller and you're going to see about 85 to 95% of what you fund that second year will become available. And by year 3, you're going to see about 100% of what you fund will become available for that year. It's going to feel a lot more like a deposit. And every year after that, you're going to get at least what you deposited into the account plus growth on the policy. So because you do not have your full capital to use right away, there is a lost opportunity cost. Or in other words, you don't have as much money to invest as you otherwise would without incurring those costs. Another drawback is that you are not able to do just a one-time lump sum payment to get these policies going without creating a modified endowment contract. If you want to stay under the modified endowment contract limits, you've got to fund the policy over at least 2 to 3 years. So if you start the policy and only fund that first year, and then you can never fund anything again into the policy, your policy is at risk of lapsing even 5 to 10 years into the policy. If you're able to fund the policy at least 2, if not 3 years at full capacity or fully funding the policy, that policy will be self-sufficient forever. But it is a drawback that you cannot do just a one-time lump sum payment. Another drawback to these policies is that it adds an extra step to what you're doing when you're investing. It's not as easy as just transferring money from a bank account or wiring that money to an operator to make the investment. You've got to go get a policy loan from the insurance company. That policy loan will come back into your bank account and then you can make the investment from your bank account. I will say it's not a huge extra step. It's fairly easy, especially once you've done it once. However, I would still classify that as a drawback because it is adding a little extra step to what you're doing with your investing. Lastly, the final drawback that I'd like to mention is that depending on who you're using to structure these policies, they can structure them in many different ways. Because of this, your policy may not be fully optimized, and if it's not fully optimized, what you actually get in your policy will not be what you were promised, which is a huge drawback because you can't just go to anybody on the street and get one of these policies. You want to make sure you're working with somebody who specializes in infinite banking style policies, what I call the investment optimizer, and make sure that they're structuring them to be minimum death benefit and maximum overfunded up to the MEC limit. If you do that, your policy will be fully optimized and work exactly the way you thought it would. If you don't do that, your policy will not perform how you expect it to be, and this is when people get frustrated with this kind of strategy. I hope you found this video helpful. If you did, make sure to give it a thumbs up and subscribe to my channel. Drop a comment in the section below and turn on the notification bell so you don't miss another one of my videos, and we'll see you next time.